Hey, what's going on, guys? Welcome back to the channel. We have a lot of important updates. We're going to be talking about the jobs report that just came out today. We're going to be talking about what it means for mortgage rates and how it has impacted the housing market. If you're new to the channel, I make these videos just to keep you up to date on the housing market. We talk about all sorts of stats and facts, and I bring some of my anecdotal stories here to the channel as well, based on what I'm seeing here in the Northern California market. If you're into that sort of thing, consider liking and subscribing. Let's jump right into the data here. Up on the screen, I have the CNBC article titled, U.S. job growth totaled 175,000 in April, which is much less than expected. And the unemployment rate rose to 3.9%. So essentially, some bad news here for the labor market. We're going to talk about what that means for markets and housing here in just a second. But key points are that the expectations for the jobs report, non-farm payrolls, was at 240,000. So we came in at 175,000. That is well below the expectation there. As far as unemployment goes, we're sitting at 3.9%. That's a small uptick. The markets were anticipating that unemployment would hold steady at 3.8%. So essentially, hiring is slowing, and in addition to that, wage growth is slowing as well. Now, this is not necessarily great news for the markets, but if you pop over to the CNBC homepage here, let me go ahead and go over there, you can see that markets are actually rallying on this news. And why is that? So we see the Dow's up 430 points, and right here, you see Dow jumps more than 300 points as weak jobs report raises Fed rate cut hopes. So essentially, this bad news is good news for markets and asset prices because the market is anticipating a higher probability that the Fed will reduce rates over the next couple meetings. And that is essentially inflationary, or at least that's what it reads here as far as the market goes. Now, if we go over to the bond market, let's look at the 10-year Treasury yield. This came down quite a bit here. Let me get it into the frame. Okay, we're sitting at 4.51%. This is down pretty substantially on the day. We saw a nice little reduction. The 10-year mortgage rates tend to follow the 10-year in rather lockstep fashion. So we see the 10-year Treasury yield go down. We start to see mortgage rates fall with it. If we pop over to Mortgage News Daily, we can see that that is exactly what's unfolding here based on today's rates at the time of this recording. We see the average 30-year fix coming in at 7.37%. This is down from about 7.5%. So not a major leg down, but we're probably about an eighth point better than where we were maybe just a couple days ago. And so this ultimately is going to improve affordability slightly, but it's not a dramatic difference overall. So we'll have to see if this trend continues maybe going into next week. Now, if we pop over to Redfin, we got a new report out, and we can see that home prices are staying very strong. In fact, the headline here is that for the housing market update, for the first time in nearly 2 years, there are no major American metros where home prices are falling. So we are well into the spring selling season here. There is still a big buyer demand. Inventory remains low, which is keeping, home prices elevated for sure, even driving them up. In fact, they talk about that here. So it says low inventory is driving prices up. New listings are up 15% year on year, but they're still well below their typical April levels. There were fewer new listings this April than any year on record except for 2023 and 2020. The year-over-year increase is also inflated because of the Easter effect. Easter didn't fall into the 4 weeks included in this year's data, but the holiday did fall into last year's comparable time period. I didn't even think about that. That's interesting. All right, and let's go ahead and switch gears. I'm going to scroll down. Let's look at some of the charts here. Okay, so we have median sales price. This is up 4.8% year on year. We're sitting just over, or actually rather just under about 385,000. You can see this has been massive growth here over the last few years. If you go back to 2021, look at that jump there. the median sales price back in 2021 for this time, basically in May, was at about 325,000. So now we're sitting over 50 grand higher than where we were just a few short years ago. One thing I want you to pay attention to here is that we can see that home prices start to rise. This is a seasonality effect going into the spring and summer months, essentially peaking out right around the June and July timeframe, and then they start to generally mellow out as they go into the winter. Median asking price, this is up 7.7% year on year. Folks are listing their properties at higher price points. You can see this rather sharp rise going back from March about to where we are right now. All right, now this one right here, this is the homebuyer housing payments, essentially what it costs, what the monthly mortgage payment is. This is a big one. Mortgage rates have sort of defied the odds here. They have been higher for longer. A lot of folks were anticipating rates were going to go down. I think that we're starting to adjust to the new normal. It's still rather expensive. We still are dealing with affordability challenges, and you can see that right here illustrated in this chart. So as of April 28th, the average monthly mortgage payment is sitting just under $2,900. We're at $2,890. Now that's based on an interest rate at 7.17%. In order to get that rate today, you're likely having some additional costs. That's not what we would call the par rate. You may have to pay some points and fees in order to secure that. As we mentioned, the national average is sitting at about 7.37 right now. So this number is likely to move up on next week's survey. And you can see that over the last few years, this right here is a dramatic jump. I mean, it's nearly double where we were here in 2021. And that is still going to remain a headwind in today's housing market. But again, with the low levels of housing inventory that we're seeing, there's still more than enough buyer demand to scoop up what's out there. That is at least what I'm seeing here in the local Northern California market, and I know it's similar across many markets here in the United States. All right, and the next one here, we have pending home sales. They're down about 3% year on year. Homes are still selling. Transactions take place every single day, but mortgage rates having gone up pretty dramatically over the last 30 days or so. This is cooling home sales. I anticipate that we're going to see this come up just a little bit here going into June and July, but it's following a rather normal seasonal trend, at least from what the data we have here shows. New listings, they are up 15% year on year. We're starting to see a rather large spike, but you can see that we're still below the levels that we saw in 2021 and 2022. So we're going to have to monitor this closely and see if we continue to see inventory levels rise going into June and July. Active listings remain slightly higher than the last few years. We're up 11.8% year on year. We have 856,000 units for sale nationally. This is still under 1 million units for sale, which equates to about 3.4 months of housing supply. So even though we're seeing the housing supply increase, anything right around 3 months worth of supply is still what we would consider a seller's market. 44% of pending sales under contract within 2 weeks. This level is down here from where we were the past few years, but still we're seeing 44%. So nearly half of all listings that hit the market, they are under contract and spoken for inside of 2 weeks. That puts the average days on market here at about 34 days, still relatively low. You can see that this is, again, following a nice seasonal trend. The days on market tend to go down as we go into the spring and summer months when people are out there actively buying and getting ready to move, and then they start to increase again going into the winter. 30% of homes sold above list price. This is down slightly from where we were over the last couple years, but still holding rather strong. Listings that have had price drops, they're sitting at 6.2%. This is above trend here for the last couple years. A lot of this has to do with the higher mortgage rates and cost of capital and dealing with affordability. But still, for context, that's one in about every 16, 17 homes. So it's not necessarily what I'd consider a big number. Then we have the average home sold coming in at 99.3% of the final list price. In other words, if a home it was listed at $500,000, they're selling for about 1% less than that, ultimately working out to, what would that be, like 496,000 or something like that. So in other words, homes are selling for about what they're listing for. And then last but not least, we have the Redfin Homebuyer Demand Index, which is down 9% year on year, and it's the lowest it's been here in the last few years. So higher mortgage rates, higher prices, some of the challenges that we're facing with affordability has ultimately reduced the buyer pool. That is no surprise there. But again, with the lower levels of inventory and sticky prices, and we still have a strong buyer demand that's willing and able to come in, and there are transactions that are taking place each and every single day. So I hope you found this information useful. If you got any value out of it, hit that like button, consider subscribing. See you on the next video. Take care.